Hi, Steve Van Metre here, and welcome to your weekly economic update where we take about 30 minutes every Friday to break down and look at the deeper issues in the markets and try to make sense of why everyone thinks stock prices just need to keep going higher. Because, well, that's apparently what people think, regardless of what earnings, profits, or any of that. It's all about the price, and that's what keeps people invested and throwing their money into the market, despite what is some absolutely ridiculous economic data saying that we are headed into a recession and may be starting the early phases of it because Europe's pretty much in a recession, although they don't really want to admit it. And Asia is rapidly heading there. They know it, but Americans still focused on stocks. But what's one of the best performing asset classes in the last 12 months? If you said the stock market, no. It's the U.S. Treasury bond market. I know, it's crazy. The one investment class that you do not hear any financial advisor talking about, you do not hear financial publications, bloggers, TV personality, radio show hosts. Bonds are going to be in a bull market really soon, and they've been rallying like crazy, and everyone says you should dump them to buy stocks. Wild. And so that kind of brings me to the thesis of what I wanted to talk to you about today. And if I seem slightly distracted, it's because one of my clients came by who I just enjoy talking to. And if he's listening, he knows exactly who he was because he was just here. And it's very refreshing to talk to someone who actually sees the world as it actually is. And he does. And a really smart businessman. And I really enjoy his conversation. Anyway, so back to the smart money and where they're positioned. You know, one of the things that I have mentioned before, and we'll show you again if I remember, is U.S. Treasury bond yields peak on average 7 months prior to the stock market. This is not it just did it in the last recession. This is every single recession in the history of our country because of our monetary system. Essentially, as the Fed tightens and slows the growth of the money supply, by default, interest rates fall. Now, the problem is investors, got to go this way because that's the way you see it, are euphoric. Oh, stock prices are never going down. Real estate prices in 2007, never going to go down. Tech companies are going to have valuations that never make sense again in 1999. They're going to go up forever. But they don't. They can't. It's not possible. And so the smart money continues to position themselves. You know, people get really excited about the Fed lowering interest rates. And as I mentioned in my video yesterday, so if you haven't watched it, I'd encourage you to, not pause this one and jump over there, but go back and listen and really discuss what the Fed tries to do with their different policy tools, one of them being flapping their jaw. And so now the focus for investors is going to be China. And anytime anyone from the Trump administration has anything to say about the trade negotiations, whether it is true or not, and I'm not sitting there trying to promote false news. I'm just saying when they get out and say, hey, the negotiations are going great, and there's actually no negotiating going on, it's to pump the stock market because people are somehow think that something so great is going to happen that's not happening. Even if we do have a deal pass through, it's not going to cause this just explosion of growth. It's not going to happen. It's just not how it works. It's like the Fed lowering interest rates back to zero. How is that going to create an economic boom? We were at zero for 8 years? No, we just go back to where we were. You can't just raise things and lower them back down and think you get this explosion of growth. It's not how the monetary system actually works. It just doesn't work that way. So as we look, how are the smart money positioned? They've been buying volatility. It's a leverage play, which you should never do. Do not buy or sell volatility, not even in the hands of a professional investor. Do not go to your local financial advisor and say, I want to short volatility or buy volatility. Hopefully they will tell you no because it's very, very risky. So don't do that. But it is a leverage play on stock prices falling. So we know the smart money is buying volatility. We know they've been buying bonds, and we've been looking at the large commercial banks because interest rates are likely headed to zero. And I'm not talking about the federal funds rate. I'm talking about 10-year Treasury yields are probably headed to zero. I will try to remember to show you why. I'm going to try to remember all these things, and we'll see time-wise when we get to the charts. They're buying agricultural commodities. Why? because you're the worst flooding in the history of worst flooding in recorded history in the Midwest. It damages crops. It gets ruined supply. Gee, you want to buy low and sell high? You buy something that everybody thinks is going down that's being destroyed by weather conditions that are only getting worse. And the smart money's selling oil. Why would they be getting rid of their oil stocks and crude oil? Because they know when economies recess, oil gets really cheap, and they want to take their oil profits and buy oil when it's maybe in the 20s or $30 a barrel, and buy all of it they can. So when it goes to 60 and 90 a barrel and they sell, they're going to make a lot of money. That's what the smart money does. They buy low and they sell high. And the key is, when you're in the late cycle of the stock market, and that's where we are, and if you get mispositioned, we did. It happens. You don't chase it, because when you play chase in the end of the cycle, you can get burned really fast, because when stock prices do fall, hopefully you remember what happened in 2000, hopefully you remember what happened in 2008, they fall so fast you can't get out. And anyone who thinks they can time the top, I just told you the answer. On average, 7 months prior to the stock market peaking, interest rates peaked. Do you know when the last time interest rates peaked? Was 7.5 months ago, and in the first week of July, it will be 8. So the clock on the stock market is not just ticking, the oven's almost done. It's almost about ready to ding. It's already cooked. The content of this video is provided as educational information only, is not intended to prevent investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in this video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. And the same thing is, why is smart money shorting gold? Because they want to buy more of it. And they want people to drive the price up so they can sell it, so they can sell the price down, so they can buy more at a lower price. As I haven't written about, I'm going to soon, maybe in 2 weeks. I've got a gold piece that I was going to put out this week, but I've cut it to next week. Once you get to 0% interest rates, you can't go any lower. Now, I know the Federal Reserve can lower federal funds rate below zero. Do you think you can get a negative interest rate mortgage? No. Negative interest rate car loan? No. Negative interest rate furniture loan? No. Maybe zero. But you can't go below zero. You got to rewrite all the math books. Can't go below zero. And that's why, see, a lot of people don't know this, but okay, I don't want to spoil what I'm going to talk about, but I'm probably going to, because we actually went to the 0% once previously in this country. And do you know when that was? I'll let you guess. It was during the Great Depression. Interest rates effectively were zero, and students of the Great Depression, such as Ben Bernanke, former Fed chair, said the problem is the Fed didn't do more than. No, the problem was we got to zero, and once you get to zero, you cannot lower interest rates anymore. It doesn't work. The show's over. Well, we were at zero for 8 years. We tried to come up out of it. You can't. Not. When you understand our monetary system, the moment you go up in interest rates, you sow the seeds for the next recession. It is inevitable. Even if you go up a little bit, someday the recession will occur. And we can't go below zero. But that means long-term bond yields are going to go to zero, because this is the next step they can go. It's the only place. I mean, there's $13 trillion of negative yielding government debt in the world. And we're one of the highest yielding ones in the world. So where do you think money's going to go? U.S. Treasury bonds. Where are they headed? To zero. They are. They're going to head to zero. I'll show you. Money supply. All right, on to the money supply. Growth rate is rising. And you go, wait a second. I thought we should see it falling. All right. In an ode to my wife, who I do know listens to this, we're going to ring the bell, because monetary school's in session. If you've ever listened to MC Hammer, there's a song that he does that. So kind of joke around our house. So it's time to ring the bell. Monetary school's in session. Let's talk about the money supply and why it shifts. Why rising money supply right now is actually a good thing for bond investors. So normally, when the Fed is easing, lowering interest rates, quantitative easing, pumping money into the economy, what should the money supply do? Should grow, right? Should rise. that is what should happen, okay? So that would be an expectation. Now, what happens to the growth rate of the money supply when the Fed is tightening, raising interest rates, unwinding their balance sheet or quantitative tightening? What does that mean? It means the money supply should slow down or decelerate. That is what should happen. So what happens when the Fed is easing and the money supply crashes or decelerates? It tells you something is wrong. In our monetary system, if you see the Fed easing and the money supply crashing or decelerating, it means people are defaulting on their loans. It's not working. That's what happened, go back to the housing crisis. Why the Fed was just pumping money into the economy like crazy, boom, 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 boom. And it didn't have any effect because when a loan enters delinquency and then defaults, they technically banks have to say that money is removed from the money supply until it crashes. So what happens when the Fed is tightening? Okay, so now let's move to where we're at now. So the Fed is tightening. The money supply previously has now been decelerating, and now it's headed up. So, well, that must mean the economy is turning around. Nope. That's why I said ring the bell. School's in session. Now you're going to learn something really cool that 99.9% of all financial advisors have no clue about, and maybe even fewer than that. When the money supply starts to rise during a monetary deceleration, because the Fed is tightening, okay? Just so we're very clear, even though the federal funds rate has not increased in a while, since December, the Fed is still unwinding their balance sheet. So they are, by default, tightening, okay? They are reducing the money supply. So if the money supply is growing, what does that imply? Well, it means that people are selling assets, i.e. stocks, bonds, real estate, assets, something of value, and they're putting the money in cash because the money supply is a function of cash in various different places. So let's stop a second and think about that. Are retail investors selling stocks? No. Are corporations selling stock or buying? They're buying stock. So retail investors are buying stock. So that if they were selling, they'd be increasing the money supply. Corporations are buying stock, so they're not. So who is? The smart money. Look, they know this thing is way overcooked. So when you start to see the money supply rise in a middle of a monetary deceleration, it means interest rates are going to go down. Why? Because when money starts showing up that has nowhere to go, it tries to find a loan to back it. And if it can't find a loan to back it, so the money's being productive, interest rates go down. So here you go. Money supply is rising because money is going into cash. Growth rate increased to 4.53%. 6-month rate of change is at 2.74%. So that would be equal to, multiplied by 2, 5.5% growth rate. So that's telling us that the money supply is really going to start accelerating here as people exit the market. And the 3-month rate of change is sitting at 7.75 on an annualized rate. It tells you everything. People are dumping stocks because I'll show you, we're not seeing it anywhere else. They're dumping stocks and raising cash because something is wrong and the market knows it. And that's why part of the reason interest rates are headed down, despite the fact that the market tells you completely otherwise. So, all right, so commercial industrial lending. Now we're going to do a test. Do we see money supply growth? Because how does money supply grow in our country? People borrowing and spending, and then borrowing and spending and borrowing and spending. So you look at the growth rate of commercial industrial lending, which is the biggest generator of loans in the country. And it ticked up a little bit to 7.13%. You go, aha! Steve, there it is. Nope. Let me show you where it is not. Okay. So here is, I've downloaded the commercial industrial loan data. See, it says commercial industrial loan from the Federal Reserve website. Here's the annualized rate of change, 7.13%. Here's the 6-month rate of change, sitting at 2.37. So we can look and see the 6-month rate of change is decelerating, whereas the year-over-year rate of change is decelerating, but not that quickly. Look at the 3-month growth rate in commercial industrial lending. It's minus 0.11%. It means that commercial and industrial loans are contracting, meaning there is not enough borrowing going on to support how many loans were done 90 days ago. It's less. And if we look, I made my own chart of the short data because you can't use the Federal Reserve site to look at the 3-month rate of change. Look what happens. The blue is the annual, the orange is the 6-month, and the silver is the 3-month rate of change. So look at that. Boom, you've come down. Now this is going back to 1975, so back when I was born. So let's fast forward to times that I do remember. There was a mild recession in the early 90s when I graduated high school. I do recall the stock market eventually choked on itself, but look at commercial industrial lending. All was in negative territory. Now, the next time commercial industrial lending contracted, again, always led by the 3-month rate of change, was in 2001 as we were in the tech recession. And then you can see it stayed contracted there for a while. Oh, wait, the next time it contracted was in 2009, right in the midst as it was. Well, you can see it was really falling off a cliff as the 2008 recession was happening. Got a little burst here and then boom, so it contracted there. But now look, in 2016, it almost contracted. In 2017, it did. Remember, we almost had a recession, then we should have. But China injected a massive amount of their currency reserves into the global economy. Notably, they do not have that now. And then we got a tax cut mainly to benefit corporations. Today, now we're back seeing the 3-month rate of change contract. The 6-month rate of change is slowing, and the 12-month is going to start crashing. If you just follow along these dates, you will notice that we are in a recession when, by the time the 12-month rate of change hits negative. But you will notice that most of the time, the 3-month rate of change is contracting after the stock market starts to fall. Now, it's contracting ahead of everything. And so when we analyze why interest rates are falling, it's pretty obvious. Lending demand is going down. So all these people that are shorting bonds thinking interest rates are going higher are wrong. Is the money coming from the consumers? Looking at credit cards and other revolving debt, the growth rate is flat at 4.15. So no, consumers are not driving the money supply growth. How about the Federal Reserve? Nope, they contracted their balance sheet by $5 billion last week. So nope, no growth there. They're definitely still tightening. How about total savings deposits at depository institutions? No, it's only at a 1.93% rate of annualized rate of growth. So we're not seeing it here. This is obviously money from stocks. And who is selling? The biggest players are selling again. Now, this is a great chart, and I don't remember who posted it on Twitter to give them credit for this or somewhere else. But this was done by a large investment bank who said, look, when the Fed raises interest rates, and they drew a channel here to say, look, you can only go up so far before you break the system, you get a recession. And I've said that this was too tight. Now, the federal funds rate is only at 2.25% to 2.5%. However, if you factor the Fed's balance sheet unwind, which you have to, it gets tighter. And so what they're showing here is the Atlanta Fed shadow federal funds rate is way up here and they said that we went up 6.25%. My number was 5 3/8. That's pretty good. Or 5.38%. That's pretty good. I mean, for a guy who does not know exactly how they calculated this, and I used someone else's information to determine it. Thank you, Dr. Lacey Hunt. I used his estimates to figure out my estimates, and bam, we have over-tightened, as I've said. And when you over-tighten, you eventually get a recession. And going on to that, this was posted by, I forget his last name, Jeffrey from Alhambra Investments, and he's saying the 6-month cumulative change of banks' own dollar liabilities is in trouble. And the last time it was in trouble, we were coming out of the recession 2009, but you can see this thing's in dangerous territory. He's saying there's major problems in the plumbing of the global financial system, hence why banks are buying bonds, which we will look at. This came from Northman Trader. I probably could have made this chart, but he made it and posted it. So he's saying when the civilian unemployment rate left, it crosses the effective federal funds rate, which is really way up here, He says every single time the Fed cuts rate when unemployment was below 4%, a recession immediately ensued and unemployment shot to 6 to 7%. Bingo, there it is. So we'll see when that happens. The cash freight index of shipments on a year-over-year basis is actually really bad. It's worse than the transportation recession 2016. And freight shipment volume in the U.S. dropped 6% in May compared to May last year, the sixth month in a row of year-over-year declines and over the sharpest year-over-year drop since November 2009. Thank you, Wolf Street, for that chart. This is great. This came from Real Investment Advice. We've shown a chart similar to this before. But when the U.S. Treasury yield curve, which is shown inverted, is going up, again, it's inverted, volatility rises. And if you're the smart money, why wouldn't you be buying volatility? Except do not buy it. It is very, very, very risky. It is not intended to be used. Unless you're a large pension fund or a very large money manager, you should not be buying volatility. Even if you think you know what you're doing, do not buy it. And you can see that the smart money realizes that at some point volatility is just going to spring out of the markets. And then this is from Peter Brandt, classical chartist, talks about, according to his charts, if we do get a breakout over this long, now almost 6-year channel that I've been talking about, he said the first move is going to be to around 1900. And then based on the measurements, he's saying that gold is going to go up by about $1,000 an ounce. At least if you're using around 1300. That is a substantial move, big move for the gold mining stocks. All right, so let's get on to the web page stuff. Where is that on my screen? Here it is. All right, first things up, NASDAQ, McClellan Summation Index, with stocks at all-time high. This should be up there again, saying there is something wrong in the plumbing of the market. This should be higher, so something is wrong, and this will be right until otherwise. But this should be well into positive territory. It's bounced off of minus 300 up to minus 150, but that is telling us something still remains wrong. Looking at the assets of commercial banks in the U.S., we see Treasury and agency securities, boom, up $5 billion. So banks are still buying bonds. I figured they would slow down. There's got to be some pattern because somewhere periodically once a month they're buying a lot of bonds. It could coincide with the Treasury auctions, the long-term Treasury auctions. Not sure, but it could, I think it does. They dropped some mortgage-backed securities, $3 billion there. And they added a bunch of non-mortgage-backed securities to the tune of $8 billion. So you have $13 billion less 3, so a net $10 billion purchase of bonds by banks. Again, all the people are saying don't buy bonds. The smart money is. Looking at the market U.S. composite factory and services data, which the S&P 500 follows. So going back to early 2017, you can see these things are generally in sync. And when the factory data starts to go down, so does stock prices. It's the saying the stock prices should be S&P should be well under 2,000. There you go. And for looking at the agricultural commodity sector, yes, summer is finally showing up to the Midwest in the next week. But along with still rain, they're still getting a lot more rain than they need. Seasonally, this rain is high, and hybrid crops do not grow well when they are sitting in water. Looking out to the 2-week forecast, you can see that temperatures are going to be fairly mild. Hey, about average for us, so that means still be hotter than, well, we can't say. But still, look at persistent rain in the Midwest. There's still going to be rain all over the farming region in here. So again, not good for crop conditions. So where are we at here? 23 minutes. Yeah, I kind of figured some of that, I still think what I go over is worth it. All right, I promised to show you the lag between yields and stocks. So let's do that. Let's go to the 20-year chart. Okay, when did the stock market peak? Roughly August, September of 2000. 10-year Treasury yields. Okay. January of 2000. There's 7-8 months. Okay. S&P 500 peaks October 2007. And here you go. June 2007. So 4 months. If you really want to push it, you can go back to here. There's your 7-month lag right there. So where are we today? Well, the S&P 500, we'll just assume that this could be the peak. I don't know, but feeling like it. Okay, so June. And here you have back in first week of November, almost 8 months ago. This works like clockwork. So there you go. Yields are telling you exactly what's coming for the stock market. Let's take a look at the S&P 500, looking at a 2-year chart. I drew this in the other day for fun. It's not technically accurate, but I just drew this point to this point and let it slice through this little bump here, thinking that this was not valid, only because I was curious if the stock prices would get up and touch the orange line. And amusing to myself, it actually did. All that to say is maybe this is the ring the bell top. I don't know. But if all the other data is correct, this has a substantial way to go down, especially when we look and overlay 10-year Treasury yields, as we kind of routinely like to do. Where is it? Boom. So there you go. It's telling us, at least based on the S&P 500, we need to get down to 2,400 on the S&P. Now, another thing I was looking at is from the point where the stock market peaked. So that was what, September-ish of 2000 and October of 2007. So let's look at what happens to Treasury yields to September 2000. Boom, right here. So we'll look at long-term. Well, okay, we'll look at 10-year Treasury yields. Let's do that. September should be right here, somewhere right in here. So let's just round this off. Yields were around 5.8%. And over the course of, 1 year, 2 year, 2.5 years, they dropped to 3%, or they dropped 2.8%, generating a double-digit return. Now let's go to here. We're following the stock market. So we'll say if the stock market peaks and you buy bonds, so that would be roughly October 2007, somewhere, say right in here. We'll say around 4.3%. And 1 year later, they were just sitting shy of 2%, meaning they dropped 2%. When you look at that with 30-year Treasury yields, a 2% drop is worth over a 30% price return, not factoring dividends. Wow. Buy bonds. As one macroeconomist-ish, macro trader says, buy bonds where diamonds. Yep. Bonds are the place to be. Looking at the volatility index, you can see it's trying to make another bottom here. This thing has got a lot of mileage to move up. If the smart money is right, they generally are. And volatility breaks over, well, this is the ETF. If volatility breaks over 40, stocks are going to blow apart. So we've looked at bonds, looked at stocks. Let's look at gold. Well, let's look at the dollar first. A lot is being made out of the dollar, breaking its 200-day moving average. Oh my God, dollar is bearish. Dollar is, I know the dollar is going to roll over and go down, but there's usually one last hurrah on the dollar. Almost always is there one last hurrah on the dollar. Let's look at the weekly chart. This is the 200-week moving average. You notice the dollar follows it fairly well. This is the moving average. Oh, look. It's just coming back to where the 200-week moving average is. At a place of support. I don't have any. I moved my lines off of here, but it is a fairly decent place of support. And the reason you know that is because you can see this is where other people have bought the dollar in the past. So why do we see this action in the dollar? Well, it's real simple, because hedge fund managers are trying to yank gold higher. They're trying to force gold's hand up. Even though gold, as I've shown you, follows volatility higher, they're trying to get a breakout here because they know that if they can get people to buy into gold, it will go to 1,700 pretty quickly, because there's not what's called a lot of resistance, or a lot of people that were buying or selling in this gap. So they're trying to jump this gap to put some nice returns on their portfolio as the quarter ends. I just don't see it happening, because all the arguments is war of Iran. Yeah, well, I think that's kind of squelched at the moment. At least it appears to be, but they're trying to get a technical breakout of gold. We will see what happens, but really, even though my green line is here, you've got to get over this 1450 level, 1415 where it did top here. I still expect this to come pulling back down. Remember that Wyckoff chart, you see the bottom here, a high, a higher high, and then a drop. If the dollar rebounds up off of one of these moving averages in here, and starts to move higher, it will reverse gold. It's just going to happen. Let's see what timing wise we have. Oh, none. All right. Well, let's just wrap things up real bit, and we'll be back, of course, on Monday. There will not be a video on Wednesday since the markets are closed for July 4th. Wait, no, that's not July 4th. That's a week after. So there will be a video on Wednesday, and with the G20 summit kicking off at the end of the month, we'll find out what's going on with the trade war. I really don't think anything's changing, but the corporate share buyback blackout begins. So we'll just see if the stock market holds up or if the outlook for earnings for the coming quarters is bad. And I think it will be, hence why smart money they're buying bonds and buying volatility. Not that you should ever buy volatility. I'm Steve Van Metre. Have a great weekend. Bye now.